All right, let's talk about a few details pertaining to underwriting and managing policies and how that relates to things like adverse selection and so forth. So for adverse selection is basically a situation in which um, you have a problem that occurs with the insurance model and who's buying insurance. So the basic idea, if I go back to sort of a typical example with homeowners insurance, let's suppose that we go back to the example I used in that first video where we had 100 homes, each worth $100,000, and that's sort of my insurance pool. And basically with that, let's say it was the 1% risk of loss. And so on average, you'd expect to lose $1,000 and so forth. All right. So the insurance company looks at the average expected loss of $1,000 and basically prices the policy in order to account for that and try to make a little bit of a profit. The adverse selection situation is when the risks facing the different individuals create a problem with who's buying insurance. So let's follow that example a little bit further and see what happens. So let's suppose that not everybody in that pool of 100 homeowners has the same risk of fire. Let's suppose that some of them are in an area that is ridiculously at a risk for fire. Well, if that's the case, then what happens is the expected cost would get a lot higher for those homes. So what can occur in that case is if the insurance company starts looking at that and they figure out their expected losses from however many houses are going to burn down, they calculate that out and they start charging progressively more money to cover the higher expected losses, which makes sense. Well, what can happen in that case is a situation in which basically the people who are in homes that are in very low risk of fire, maybe they have a home that's built entirely out of concrete or something, and so it's very low risk of burning down. It's very difficult to burn down when it's entirely made out of concrete. And so if that's the case, they start looking at that and they say, well, why am I paying for fire insurance when my house can't burn down? So let's say they drop their home insurance. So they drop their home insurance because they're at low risk. What that leads to is a situation in which the only homes that are left are the homes that are at higher risk, which means the costs that the payouts the insurance company are facing get even worse. So that means they would need to raise the prices of the policies even more. And what can happen in that case is more people drop out, which means only the people who buy the insurance are the ones that are higher risk. And that's basically the core idea behind adverse selection. That essentially what winds up happening is a situation in which essentially we're sort of getting more and more and more and more of the policies that are going to have more and more and more cost. And basically those are the people who are left over. And so basically the people who need the insurance the most because they're most at risk are the ones that are actually buying the policies, and the people who really don't have too high of a risk don't buy any policies. And so as a result, basically the policies get more and more and more and more and more expensive. And this makes less and less and less and less sense for the insurance company to offer those policies. So that can be a real problem. If it gets bad enough, it can actually lead to sort of a death spiral where basically you get more and more and more expensive people buying the policies, more expensive in terms of the expected losses. And you're losing more and more and more of the people who are less expensive in terms of their expected losses. And so the whole cost structure just blows up and the insurance policy no longer makes any sense. So an example of this in the sort of the health insurance situation would be, what if I have a whole bunch of people who are very healthy and they get looking at health insurance and they think, well, I'm pretty healthy, so I'm just going to drop my health insurance and not pay. Well, if that's the case, if everybody who's super healthy drops out and doesn't buy health insurance, then the people who are really sick are the only ones buying health insurance, but they're also super expensive. And so the whole idea behind insurance is that you're looking at a pool of possible outcomes, right? And so if everybody who is super healthy drops out of the pool, and the people who are all prone to being super sick stay in the pool, the expected payouts by the insurance company shoot through the roof. And when they shoot through the roof, the cost of the policies they're going to have to write is going to go up drastically too. So from that standpoint, it can basically kind of destroy the insurance policy. So one of the ways that underwriters try to manage some of these kinds of things a little bit is with deductibles and copayments. And this is basically designed to kind of nudge people away from making as many claims, particularly at the low end of expenses, and to try to ensure that that people are only making claims when it really is required. So with a deductible, if I have a deductible of say $1,000 on my homeowner's insurance policy, what that means is if a tree falls on my home, I'm paying the first $1,000 of the damage. Then if the damage is over $1,000, then the insurance company is going to get involved. And so basically what that means is the insurance company is not going to deal with the smaller costs. And I'm only going to, it's only going to pay for me to talk to my insurance company if the damage is actually pretty substantial. And so that also means that I'm less likely to make frivolous claims over, $500 because the insurance company's not going to pay for it anyway. If it's $1,500, well, then I could pay my $1,000 and then the insurance company could perhaps pay the other $500. But if it's relatively minor in damage due to some kind of event like that, the insurance company's not going to get involved. And that basically keeps the cost of the insurance companies down a little bit, which helps to keep the cost of the policies a little bit more reasonable. That's also why sometimes copayments are required. So for a deductible, it would be, let's say that we had a situation in which I had a homeowner's insurance policy with a deductible of $1,000. And let's say there was a 10% copay requirement after that. So if that was the case, what that would mean is if a tree falls on my house and causes $1,500 of damage, first off, I'm going to pay the first $1,000. So the first $1,000 I'm paying for. Then we got $500 of damage after that I'm going to talk to my insurance company about. Well, if there's a 10% copay requirement on any of that, then 10% of that 500 is $50. I'm going to have to pay that $50 as well, and they're going to pay the $450. And basically what it means is that the policy holder, the person who bought the policy, they sort of have the proverbial skin in the game, where they're going to have to make some payments on this, which kind of provides an incentive for them to not make a lot of claims because they're going to have to pay for things. It also gives them an incentive to try to keep the costs of the repairs lower and things like that, right? Now, that also brings up an interesting issue pertaining to something called coinsurance. And the idea here is that basically we're going to look at the insurance coverage that the insured person has relative to the amount of coverage required by the coinsurance provision. And then we're going to use that to kind of scale the payment the insurance company is going to make. So let me give you sort of an example. Homes can increase in value over time. They don't always, but they can. And so one of the challenges you could run into with that is, let's say I bought a homeowner's insurance policy last year, and my home was valued at $80,000 last year. So I insured it for $80,000. Obviously, this is low, but I'm keeping the math nice and simple. So let's say it was $80,000. And let's say my home is increased in value to $100,000. Okay. But my insurance policy is still at the $80,000. So what's going to happen is basically the insurance company is going to look at essentially any loss that occurs, and they're going to say, all right, well, you had $80,000 of coverage. What you really needed to properly cover this property was $100,000 of coverage. So you had $80,000 of coverage. You needed $100,000 of coverage. So you were at 80% of the coverage that you really should have had for this property. So if I'm at 80% of the coverage we really should have had, then we're going to use that 80% times the damages. So basically, I'm going to take that 80% times and if I use that example, $1,500 of damage. So I'm going to take the 80% times that, and I'm going to get that number. And then once I have that number, which I believe would be, let's see, challenge my mental math here. So I think that would be, let's see, 80% of that. So I think it's about $1,200. So I'm going to take $1,200 minus the deductible. Let's say the deductible was $1,000. So if the deductible was $1,000, then we're going to take the $1,200 minus the $1,000. The insurance company is just going to pay the $200 extra. And so basically what's happening is the insurance company is going to scale how much they're going to pay relative to the coverage you have, given what you should have had. And so if you're kind of underinsured, well, they're not going to pay the full amount because you should have had more insurance. You should have been paying for more insurance. And so they're not going to pay out as much. And that's the idea behind coinsurance. The idea behind all of the deductibles and copayments and coinsurance is basically to ensure for deductibles and copayments that sort of you have skin in the game and you have a vested interest in not having losses and things like that, and that you're participating in whatever the losses are. So that hopefully you're mindful of how much you're paying and thoughtful about that. Coinsurance is designed to ensure that you have the coverages that you're supposed to have, and so that the insurance company doesn't wind up paying for a whole bunch of stuff when you didn't really haven't been paying them for the proper level of insurance. So that's kind of the idea behind those. Hopefully this helps. Have a great day.